Is what you should be looking out for this week. So it's 6/2, start of a new quarter. This is exactly what you guys should be keeping your eyes on for this week, heading into basically a brand new week with a lot on the line here. When I say a lot on the line, I mean where we're sitting on the chart. We are in this tight little range here. I've alluded to on this program before, but just so you guys are aware, we're at a very key level here, and we are just chopping along. Now, there is just as likely of a possibility to come to the bear side as there is to the bull side. And I think first thing we should keep an eye on are our catalysts for this week that could force us either which way. Now, today is Monday. We have Powell speaking, so that's obviously the big one. Looking forward to the rest of the week, though, and at least solely focusing on the U.S., unless there is something out of the country that is important that could affect us more importantly. You got JOLTS tomorrow. Big economic information here that you want to be aware of. That's at 10 o'clock. I have a show tomorrow at 9:15, so we'll be covering that live. So if you want to come by, check that out then. But JOLTS tomorrow at 10 o'clock. That's going to be big. Outside of that, you have more Fed speakers tomorrow. This is a Fed-heavy week. So when these people are speaking, it's not that the market will be bullish or bearish. It's just that you need to be conscientious of two things. One, if they are more dovish or hawkish, because that could affect the market. And two, just be aware that they're speaking. Meaning, if you have a dovish speaker that's speaking right now, you may think to err more on the side of bullishness, but also you need to think if this is a dovish person, they say something that's more hawkish, that's going to be very bad because the market already acknowledges this person as a dovish individual. So them saying something hawkish could be bad, vice versa, right? Someone who's hawkish saying something dovish. So use these as your risk parameters. So you have 3 Fed speakers tomorrow, basically back to back. Goolsby, Cook, and Logan. Then going into Wednesday, we've got more PMI data at 9:45. Bank of Canada has some rate decisions that could impact our market, especially with trade and everything going on right now. We want to have kind of an idea of how other companies that affect the U.S. market are handling interest rates right now in general. But outside of that, you do have Beige Book on Wednesday. Can be impactful. It's really a hit or miss thing, so at least be aware that that'll be at 2 o'clock during market hours. Thursday, not too much. You do have jobless claims, so at 8:30 pre-market, and as well as trade balance. So those are 2 things you want to keep an eye on. And then more Fed speakers. So you got Kugler and Hawker at 12 and 2:30 respectively. And lastly, on Friday, at least the biggest thing in my eyes is going to be your unemployment rate. It's going to be your non-farm payroll. Those are both pre-market on Friday. So at least prepare for that from Thursday into Friday. And then consumer credit at 3 that day. So those are very important because that's going to kind of give us an idea on how the labor market is doing. And all of these things, this data-heavy week gives us an idea, or at least could hint towards where the Fed will be moving their hand if they're going to cut rates, not cut rates. Now, the narrative on that has been shifting a bit. For a little while now, the market was expecting 2 interest rate cuts, and now we've dropped it down to a 1, or at least that's the new thing that I've heard in this last week, that the market's really anticipating only 1 interest rate cut this year. Debatable theories on interest rates in general. Obviously, there's certain things that are very pertinent and relevant when you're talking about interest rates, but when you're talking specifically about interest rates, there tends to be, when interest rates start to cut from a rising rate environment, there tends to be a short-term rally, because think of it this way: when rates are cut, money's cheaper to borrow. When money's cheaper to borrow, companies that need money to borrow to survive can do it at a cheaper rate, so they can lower debt, etc. Refinancing debt, if they borrowed at a higher rate, borrowing money's cheaper, so that helps. But at least in trend-wise, and if you want to go back in time and look at the market, you can. When there has been an interest rate cut or start of a cut, there tends to be a contrition or a pullback with the market overall. There tends to be some level of a pop, some level of a hard upside move, and then a deeper pullback. So that is something I'm personally going to be aware of. Now, obviously, it doesn't affect this week for this week ahead's segment, but is this something you want to stick in the back of your mind when we get this data coming out this week? Because those things could affect how we look at the market going into further weeks. So the rest of this month, the rest of this quarter. Now, as I alluded to before, I went into the little spiel of catalysts for this week. This area is a very key area. Now, there's as much of a likelihood of a bull side and a bear side move. In fact, I would probably lean 60-40. I'd lean more bullish than bearish if I had to pick, mainly because we're above our 200 MA and our 50 MA on the daily chart, which is typically a very good sign. Bears are obviously staring at this gap to fill to the downside. Bulls are obviously staring at this upside to break to get back to all-time highs. It's a very obvious point in the chart where both sides have an argument. And volume has actually been ticking up a little bit in the last few days here as we hold this area. So there's a little bit of a fight going on here. I think the most likely scenario for the rest of this week is actually we stay in this range. I don't think the Bears get their gap fill, and I don't think the Bulls break the upside. I think if anything, we float sub 593 and north of around 577. And we sit somewhere in that range where you're not bullish, you're not bearish, but we're discovering price still. Now, with that being said, price action can be very whippy. We can move big on those days, but we're not getting out of that range, which is the important thing. At least in my opinion, that's what I'm looking at this point in time. And the longer, I should say this, the longer we sit in this range, depending on volume, that's very important, but the longer we sit in this range, the more I would argue it would actually favor the bulls. The more volume we build out here, the better, in my opinion, because at this point in time, after you had this big bull move, right, you had a little bit of a pullback, we're now cooling down from the bull move. Now, whenever there's a big upward thrust, there needs to be some level of a pullback. That's why I said there's just as much of a valid argument to get back down here and fill this gap. But you could argue that basically, and if you're assuming this week is like a chop week, price action has allowed there to be a cool down. We have just floated around here. We've stayed comfortable. We've allowed the bears to have their days, as you can see a few red candles here, right? We've allowed there to be a little bit of contrition in the market. So, at least in my opinion, the longer we hold up here in that range that I just outlined for you, the more likely that there is a bullish continuation to the upside. Now, the two things or three things you want to keep an eye on are your VIX, your VVIX, and your IWM this week to kind of give you an idea of which way the market could lean. Now, your VIX obviously is your volatility, but don't forget that your VIX is also your means of price disagreement, right? The way the VIX gets its value is by determining the spread through SPX options. So it gets its value from seeing how far the spreads are on SPX options, how far the bid and the ask are, right? So as that spread gets wider and wider and wider, the VIX increases, which makes sense. Think about it. As more people disagree on what price SPX should be, the S&P, there's more volatility because people are not willing to meet in the middle. They're saying, I think it's worth this and I think it's worth this. So there's not an agreement. That place where there's no agreement is VIX, and as there is less and less agreement, as that gap gets wider, the VIX goes up. So as a bull, at least if you want to lean more on the bull side of things, you want to see the VIX come down with this consolidation. It's very keywords. If SPY stays in this consolidation zone, you want to see the VIX come down, because as the market's consolidating and the VIX gets tighter, the market's agreeing on a price. We're saying, okay, we want the SPX to be this price, theoretically, right? The spread's getting smaller. And VIX is going to resemble that spread getting smaller, which means people are agreeing on the price of the overall market. Now, if VIX gets wider and the market stays sideways, the market is pricing in a potentially higher volatility event, meaning a bigger move either which way really, but tends to be a downside move. Now, people tend to think that, oh, volatility go up, market go down, vice versa. That's not always the case. There's about, like, I would say an 80% correlation where as the VIX goes down, the market goes up, and as the VIX goes up, the market goes down. But that's, again, probably about 80% of the time. It's a little bit more nuanced by that, and that's why I like to describe the VIX to you guys exactly as I just did, as the method of price agreement between spreads, because that's how the VIX is calculated. So understanding that will give you a little bit more inkling on which way we will push, not could, will push by the end of this week, or into next week, I should say. Knowing that, you want to also keep an eye on VVIX. So VVIX is your volatility of the VIX. It's their volatility of volatility. So how volatile is the VIX as a whole? So again, if you're a bull, you want this to come down. If you see VVIX come down and volatility come down, that's going to say the volatility of volatility, so how volatile the VIX is contracting, and also price disagreement on the SPY or SPX is contracting. There is a scenario where VVIX could go up and VIX could go down, which would hint to you that you would see a sharp reversal in the VIX, which could be a bear signal. Meaning, the VIX, let's say VIX right now is at around 19. Let's say VVIX jumps to 120. Right now it's at 97. That could hint to you that volatility is could make a sharp reversal, or the market's pricing in a potential reversal on volatility as a whole. So ideally, you want these two to move hand in hand. The last thing you want to keep an eye on is your IWM. This is your small cap, your Russell 2000. Now, you basically have kind of like an inverse head and shoulder here, and I've hit all my lines here to keep it nice and clean, so you're not staring at a multicolored old CRT TV with a broken screen. But you're basically looking at like kind of an inverse head and shouldery kind of look here, sitting on another volume shelf just like SPY. I want to see, if I'm a bull, I want to see IWM start to push to the upside before the general market, and before we see tech like the Qs push to the upside. That's going to give me an inkling that sentiment is starting to shift towards mid-cap companies, which in whole tells me the market is more risk on. People are willing to put more money into these smaller companies. They're willing to take more risk in the market. And in doing so, the IWM would go up in price prior to the market. So with that being said, we'll look over our, as I like to say, our Mag 6, because I personally don't care about Netflix. We'll look over our Mag 6 real quick, and then you guys, we kind of have a game plan for the week. We talked about NVIDIA pretty succinctly, where I'm bullish above 137, but I'm not going to be a aggressive bull or open like a bull position on NVIDIA until we're over that 140, 136 area. Right now, we wicked that 137.81 area on the day, and we're coming back down. So this could signal not necessarily weakness in NVIDIA, but again, more consolidation around this level of this 134.22 area, where it's kind of have to kind of sit here for a little bit and hang out, which would support the thesis of the overall market chopping this week. It looks like NVIDIA wants to hang around this level a little bit more. A lot of high volume here. Obviously, at earnings, a lot of high volume here. You're going to want to watch the volume next 2-3 days and see if we hang around this level. I've been very open about Apple and how it's pretty bearish. Bulls need it above 195.83. If bulls can hang above that, and you could see Friday's candle basically wicked it and closed higher, which is a good sign. If bulls can hang on to this level, it's not necessarily bullish, but you're going to be potentially like a pennant forming here, which I'm not going to draw all the lines here, but where it's going to break one way or the other pretty hard. So if you're a bull, you want this to reverse out pretty quickly, but if it gets underneath this level, there's a strong possibility we get back into the mid 170s, low 180 area on Apple, which is probably one of the more bearish Mag 6 names, as I like to say. Microsoft, I've also been pretty open about being mostly bearish here, having a real hard time breaking all-time highs. Sat up here for about 5 days right now. If we tap that all-time high, there would be a decent chance to open up a short position in and just kind of with a tight risk essentially, and have a decent risk to reward here to the downside. So I actually like Microsoft for a short here if it can stay, or if it doesn't break that all-time high level, which also supports a chop thesis on the week. Google, as of Friday, was good. Now we're gapped under the 200 MA on the daily. It's a little concerning here where it could get back to this 162-ish area. So you're going to want to keep an eye on that. Amazon, as long as it's north of 211, in my opinion, is bullish. And Tesla under 360 is a bear. I would not touch Tesla sub 360 at all. 360 to 380 is decent little supply area. And clearly, as you can see by this projection here, fourth red day in a row, not looking too good for Tesla. So as we looked at our Mag 6, more things leaning more bearish than bullish, which should be a cautionary tale as we look at the overall market and saying it could go either way, so to speak. And even though I'm personally hanging my hat more 60-40 on the bull side of things, seeing your Mag 6, again, as I like to call them, leaning more bearish should at least lean you to be more aware of your risk parameters looking into the rest of this week. All right, that's going to wrap it up for this week ahead. Hopefully you found this content helpful. If you did, drop a like, comment, subscribe, etc. Okay, bye.